So admission is over. The next topic is retirement of a partner. Introduction. According to section 32(1) of the Indian Partnership Act 1932, a partner may retire from a firm A with the consent of all the partners. Before retiring from the firm, he has to get the permission from all the partners. B, in accordance with the express agreement by the partners. It may be written in the agreement. Okay. Then C, where the partnership is at will by giving notice in writing to all the other partners of his intention to retire. If it is a partnership at will, then he has to give his idea to retire from the firm in writing to all the other partners. Sometimes, in addition to that, a partner may decide to retire from the firm because of certain reasons like old age, ill health, etc. Technically, on retirement, the old partners comes to an end partnership and new one between the remaining partners comes into existence. However, the firm as such continues. The firm continues. A retiring partner will not be held liable for the debts incurred by the firm after his retirement. After his retirement, he is not liable for the liability as well as the debts of the firm. However, he must give a public notice to that effect. In case of a sleeping partner, such a public notice need not be given. In case if he is a sleeping partner, it is not necessary for him to give a notice before his retirement. In all the other cases, he has to give a public notice about his retirement from that firm. What are the treatment, accounting treatment if a partner retires? First one, we have to find out the profit sharing ratio, the new profit sharing ratio, because if one partner retires, naturally the profit sharing ratio will be changed. Then goodwill, adjustment for goodwill. Then revaluation of assets and liabilities. Fourth one, adjustment regarding reserves and other undistributed profit and losses. Fifth one is payment to the retiring partner. He is retired and so he has to be paid his capital as well as his share of profit, reserves, goodwill and all. These are all the accounting treatment which is required at the time of retirement of a partner. The first treatment is profit sharing ratio. When one partner retires and nothing is mentioned about the new ratio between the remaining partners, in the absence of an agreement on the retirement of a partner, the mutual profit sharing ratio of the remaining partners will not change. So, if nothing is mentioned about the new ratio between the remaining partners, then in that case, we have to understand that, we have to assume that the mutual profit sharing ratio of the remaining partners will not change. Okay. Question number 1. A, B, C are partners sharing profit and losses in the ratio of 1:2:2. C retires. That is why I have changed the color. C is retired. His share of profit is 2/5. 1:2 means 2/5. Calculate the new ratio. See, the problem is silent about the new ratio. Okay. New ratio of the remaining partners or the existing partner. The existing partners are A and B. How they are going to share the profits and losses of the firm after the retirement of C, that is not mentioned in the problem. We have to calculate. In this case, nothing is mentioned about the new ratio. So, we have to assume that A and B will share future profit in the ratio of 1:2. See, in the previously, they share the profit in the ratio of 1:2. Then here also they are going to follow the same ratio 1:2. Okay. But previously they get the share of 1/5 and 2/5. Now their share is 1/3 and 2/3. They will get more amount. That is why we have to calculate gaining ratio. Here they are getting 1/5, but here they are getting 1 out of 3. So they are getting more profit than that of the previous one. Previously 1 by 5, now they are getting 1 by 3, and so they are gaining. If one partner retires, the remaining partners gets gain. Okay. Question number 2. X, Y and Z are partners sharing profit and losses in the ratio of 4:3:3 respectively. Y retires. Y's share of profit is taken up by X and Y in their profit sharing ratio. Calculate the new ratio. Who is retired? Y is retired from the firm. What is his profit sharing ratio? 3 by 10. 4:3:2. So his share of profit is 3 by 10. He retired from the firm. Here the information is given. Y's share of profit is taken up by X and Y in their profit sharing ratio. Additional information is given how they are going to share the profit of the retired partner Y. That is given in the problem. That is the Y's share of profit is taken up by X and Z in their profit sharing ratio. So what is the Y share of profit? That is 3 by 10. X will take out of his share, that is 3 by 10 into 4 by 7. What is this ratio? His ratio is 4:3. 3 by 10 into 4 by 7 is 12 by 70. X will take out of his share, the share of Y is 3 by 10 into his share is 4:3 is 3 by 7. So 9 by 70. Then what is their previous share? Previous share is X, previous share is 4 by 10, and now he purchased the share of, he has taken up the share of Y in the ratio of 12 by 70. So we have to add this portion to his previous share. The previous share is, the previous ratio is 4:3:3. So the previous share is, for X is 4 by 10, for Z is 3 by 10. Okay. So the 4 by 10 plus 12 by 70. This is the profit which he has taken up from the Y. So the LCM is 70, 28 plus 12, 40 by 70. Then Z share is 3 by 10 plus 9 by 70. Okay. So 9 by 70 he has taken up from the retired partner. His actual share is 3 by 10. So 3 by 10 plus 9 by 70 is the 21 plus 9 divided by 70, that is 30 by 70. The new ratio therefore is X is to Z is 40:30. That is nothing but 4:3. In this way, we have to calculate the new ratio of the existing partner if any information is given about their profit sharing ratio. Then the next case is when the remaining partners purchase the share of retiring partner in some specific portions. Question number 3. Kala, Mala and Vimala are partners sharing profit in the ratio of 1 by 2, 1 by 3 and 1 by 6 respectively. Vimala retires and her share was taken by Kala and Mala in the ratio of 2:1. Find out the new ratio. So the old profit sharing ratio is given. Then the purchase, how they are going to share the profit of the retired partners, that is given in the problem. They are going to share the profit of the retired partner in the ratio of 2:1. This is the question which is given. You are asked to calculate the new ratio of the existing partner. This is the answer for the above problem. What is given? The share of the old profit sharing ratio is given. Okay. That is 1 by 2, 1 by 3, 1 by 6. First we have to converted it. Okay. Then because the given is a fraction. Okay. So if we convert the profit sharing ratio between Kala, Mala and Vimala is 3:2:1. This is a profit sharing ratio. Who is going to retire? Vimala is retired. So, Vimala is retired. How they are going to share the profit of Vimala after the retirement of Vimala? The profit will go to the hands of either Kala or Mala or both according to the agreement between them. And Mala have agreed to share the profit of Vimala in the ratio of 2:1. Okay, in this way, they have a clear idea about their the profit sharing of the retired partner. Now, let us calculate the new profit sharing ratio. The Vimala's share, Vimala is a retired partner. So, her share is 1/6. So, Kala is going to take up 2/3 of 1/6. So 2/3 of 1/6 is 2/18. Mala is going to take up 1/3 of Vimala share. So the Vimala's share is 1/6. Vimala is a retired partner. So 1/6 into 1/3, 1/18. Existing partner new share, that is we have to find out Kala's new share and Mala's new share. Old share plus shares purchased from the retiring partner. Kala's new share 3/6, that is his old share, plus 2/18, which is purchased from the retired partner. So new ratio is 11/18. Mala's new ratio, old ratio is 2/6. She purchased 1/18 from the Vimala. So 2/6 plus 1/18 is 7/18. Therefore, the new ratio of Kala and Mala is 11:7. This is another case. Then the next concept is gaining ratio. The ratio is calculated when a partner retires from the firm. In the absence of agreement, after retirement of a partner, the remaining partner are assumed to continue share profit in the ratio which existed between them before the retirement of the partner. That is, the remaining partners gain in the old ratio. If the new ratio of the continuing partners are given, the gaining ratio can be calculated by deducting old ratio from the new one. Gaining ratio formula is, to calculate gaining ratio, old ratio should be deducted from the new ratio, because if a partner retired, the remaining partner will get a share of the retired partner profit. Okay, so their profit share will be, amount of profit will be increased. They are gained due to the retirement of the partner, and so we have to calculate the gaining ratio. So the new ratio is more than, the greater than that of the old ratio. So we have to deduct old ratio from the new ratio in order to calculate the gaining ratio. This is question. You are asked to calculate the gaining ratio. Kannan, Krishnan and Gopalan are partners sharing profit in 5:3:2. You are required to calculate the gaining ratio when Kannan retires, Krishnan retires, Gopalan retires. His name is Kannan, Krishnan and Gopalan. Their ratio is 5:3:2. In the above problem, new profit sharing ratio of the continuing partner has not been given. So the continuing partner gain in their old ratio. Case 1, when Kannan retires, the gaining ratio of Krishnan and Gopalan is 3:2. Case B, when Krishnan retires, the gaining ratio of Kannan and Gopalan is 5:2. Then case C, when Gopalan retires, the gaining ratio of Kannan and Krishnan is 5:3. Next question. A, B and C were partners sharing profits in the ratio of 2:2:1. C retires and a share was taken up by A and B in the ratio of 3:2. Calculate the gaining ratio of A is to B. Okay. So there are three partners A, B and C. they are sharing ratio, they are sharing profit in the ratio of 2:1. Who is retired? C is retired, and his share is taken up by A and B in the ratio of 3:2. You are asked to calculate the gaining ratio. So the old profit sharing ratio is 2:1. C's share is 1/5. C's share is taken up by A and B in the ratio of 3:2. So A 1/5 into 3/5 is 3/25. B 1/5 into 2/5 is 2/25. A's new share is 2/5 plus 3/25, which he gets a share from C. That is C's share he purchased is 3/25. So 10 plus 3/25 is 13/25. B's new share is old share is 2/5. He purchased C's share to the extent of 2/25. So his new share is 12/25. We have to calculate the gaining ratio. Gaining ratio is equal to new ratio minus old ratio. So A 13/25 minus 2/5. New ratio is 13/25. Old ratio is 2/5. So the gaining ratio is 3/25. B is 12/25 minus 2/5. That is why the new gaining ratio is 2/25. Therefore, the gaining ratio is 3/25 is to 2/25. It's nothing but 3:2. Then the distinction between sacrificing ratio and gaining ratio. Meaning, the sacrificing ratio meaning is, it is the ratio at which old partners surrender a part of their old shares in favor of incoming partner. Then gaining ratio means, it is the ratio at which the continuing partner take up the retiring partner's share. So, at the time of retirement, the old partners, the existing partners, after the retirement of the partner, they will share, they will get a share. They will get more amount because one partner is retired from the firm. Okay, so his share will also come to the existing partner. Okay, suppose if the firm earns 10,000 rupees, there are three partners A, B, C, then they have to suppose 12,000 rupees if a firm earns. A, B, C, the equal ratio, they share profit and losses in the equal ratio. Then each will get 4,000, 4,000 and 4,000. So if C retires, if the firm earns same 12,000 rupees, the share of A, if they continue to share the same ratio, profit in the same ratio, then A will get 6,000 rupees and B will get 6,000 rupees. Okay, their profit share, the share of profit will be increased because of the retirement of one partner. After the retirement, their share of profit, their amount of share profit will be increased. That is why we have to calculate the gaining ratio. Okay. Then purpose. It is calculated to determine the amount of compensation to be given to the old partner by the incoming partner. So here, why we are calculating the sacrificing ratio? New partner, when a new partner enter into a partnership firm, then the old partners have to sacrifice some of their share of profit to the old partner. Reversal of the gaining ratio. If one partner retires, then if the firm continues, the existing partner will get more amount than that of the previous one. But here, if one partner enter into a partnership, the old partner's share will be reduced because they have to share the profit of the firm to one more person. If one partner is admitted, their share will be lesser. They will get the share of lesser amount. If two partners are admitted, then again their share will be reduced. Okay, because they have to share the profit to the new partners. They have to sacrifice some portion of their profit to the partner who is entering into the partnership. So that is why we are calculating the sacrificing ratio, how much they are sacrificed, that we have to calculate. Then the new partner has to bring cash to compensate the sacrifice which is made by the old partner. Here it is calculated to determine the amount of compensation given to the retiring partner by the continuing partner. So after the retirement, they will get more profit or more shares. For that, they have to pay compensation to the retiring partner. In order to calculate the amount of compensation that should be given to the retiring partner, gaining ratio have to be calculated. Then when calculated at the time of admission of a partner, sacrificing ratio is calculated. Here at the time of retirement, this gaining ratio is calculated. Method of calculation. We are calculating the sacrificing ratio by way of reducing new ratio from the old ratio. Here the formula is gaining ratio is equal to new ratio minus old ratio. So these are all the differences between sacrificing ratio and gaining ratio. Then the next concept is goodwill concept. How at the time of retirement, how the firm treats the goodwill. Whenever a partner leaves a partnership firm or dies, the effort he took to enhance the goodwill of the firm cannot be ignored. In case of retirement or death of a partner, goodwill cannot be raised in the books of the firm because no consideration in money or money's worth is paid for. But the value of the goodwill of the firm will have to be calculated, and such value has to be adjusted in partner's capital account directly. Say that is the retired partner, as well as if a partner dies, his legal heir will get a share in the goodwill. He has got a right. The retired partner has got the right to get a share in the goodwill. If a deceased partner, legal heir is also got the right to get the share in the goodwill, because they are also working. They worked hard to enhance the goodwill of the firm, and so they are working. They are hard working. Their effort to enhance the value of goodwill should not be ignored, and so they have to be given a share in the value of goodwill. So, but the value of goodwill of the firm, we have to calculate. See, we should not raise the value of we should not arise, or we should not enter the goodwill in the books of the firm, because no consideration in monies or money worth is paid for it. But at the time of the retirement or at the time of the death, we have to calculate the value of the goodwill, and that amount has to be entered partner's capital account directly. This is the accounting treatment of goodwill. Then first case, existing goodwill. In case goodwill already found a place in the balance sheet at the time of retirement or death, such goodwill has to be written off by debiting all partners' capital account and in their old profit sharing ratio and crediting the goodwill. The journal entry will be all partners' capital account data to goodwill account. If already there is a goodwill in the firm, we have to pass journal entry in this style. The new goodwill. If the value of goodwill of the firm is ascertained on the date of retirement or death of a firm, the share of retired or deceased partner in such goodwill is to be found out. Then the share of retired or deceased partner is to be debited to the continuing partner capital account in their gaining ratio and credited to the retiring or deceased partner's capital account. The required entry is continuing partner's capital account data to retiring or deceased partner's capital account. Okay. Then, if a continuing partner makes any sacrifice, the entry would be continuing partner's capital account data to retiring partner bar deceased partner capital account, and again we have to credit the continuing partner's capital account if he has made any sacrifice at the time of the retirement or death of a partner. So this is the way to treat goodwill at the time of retirement. Hidden goodwill. In case a firm has agreed to settle the accounts of the retiring but deceased partner by giving him a lump sum amount, then the amount paid to him in excess of his capital and share in reserve, revaluation, profit, etc. will be treated as a share of goodwill, that is hidden goodwill. So usually the retiring partner as well as the deceased partner legal heir is settled through installment. Okay, 3 installment or 5 installment, they agree, they have an agreement, and they will settle the amount accordingly. But if a firm gives lump sum to settle the amount, then we have to compare the amount which has to be repaid or which has to be settled to the partner and the actual amount. If the actual amount is less than that of the settled amount, say for example 1 lakh rupees is the amount which is paid to settle the retired partner, but the actual capital of that retired person in that firm is 19,000, then we have to assume that 10,000 rupees is the hidden goodwill. Say, see this problem, X, Y, Z are partners, Y retired. His capital account balance after adjusting reserves and revaluation profit is 2,60,000. Y have agreed to pay him 2,85,000. So who is retired? Y is retired. Then his profit in the firm is 2,60,000 rupees. But the remaining partner X and Z have agreed to pay him 2,85,000. That is 25,000 more than that of his capital. Why they are giving 25,000 more? That is the Y's share in the goodwill of the firm. So this is the hidden goodwill. Okay, this amount will be debited to X and Z capital account in their gaining ratio and credited to Y's capital account. If they pay more, if they settle more amount, that is higher amount than that of the actual capital, then we have to assume that the difference is nothing but hidden goodwill. Then like admission, at the time of retirement also, the assets and liabilities of the firm has to be revalued. It is necessary that the retired partner is given a share of all the profits that have arisen till his retirement and is made to bear his share of loss that have occurred. A revaluation account is opened exactly in the same way as shown when admission of a partner is discussed. The profit or loss on revaluation will be distributed among all the partners, including the retiring partner, in the old profit sharing ratio. We have to open the revaluation account, then the profit or loss should be shared between all the partners, including the retired partner, because retired partners have got every right to get a share in the revaluation account profit, or if the firm suffers, if the revaluation account produces loss, then the loss also should be borne by him. Okay, a retiring partner, including the retiring partner, the revaluation profit or loss should be transferred to the capital account in the old profit sharing ratio. Sometimes the continuing partner may decide not to alter the value of assets and liabilities in the books. In such a case, a memorandum revaluation account should be prepared. This account consists of 2 parts. First part is prepared in the same way as revaluation account. In the next part, the entries passed in the first part is reversed. The result in the first part shall be divided among all the partners, including the retired partner, in the old ratio, and the result of the second part shall be divided among the continuing partner in the new partners in the new profit sharing ratio. When memorandum revaluation account is prepared, assets except cash and liabilities appear to the new balance sheet of the continuing partner at old ratio. Memorandum revaluation account already we have seen in the admission. Here also we have to prepare the memorandum revaluation account if the old partners decide to not to alter the value of the assets and liabilities in the book. The first part, we may get either revaluation profit or loss. That should be shared between all the partners including the retired partner in the old ratio. Then the second part is the reversal of the first part. If the first part, in the revaluation account, if a firm gets profit, in the second part it will suffer loss. Okay. So it is a reversal of the first part. Okay. So that should be distributed among the remaining partner in the new ratio. So in this way we have to prepare the memorandum revaluation account. See, when we follow the memorandum revaluation account, then in the balance sheet we have to consider only the book value of the assets and liabilities. The assets and liabilities values should not be changed except cash. Then treatment of undistributed profit and loss. Already I told, a retiring partner has got the right retiring as well as the deceased partner. In case of retiring partner, that person itself can be settled. But in the case of retiring death, deceased partner legal hair should be settled. Okay. So what is the entry for that? The general reserve or reserve fund or P&L account debtor to partner's capital account, including the retiring partner, okay, in the old ratio. Then for if the firm suffers losses, then all the partners capital account debtor including the retiring partner to P&L account. So this is the style to pass journal entries to treat undistributed profit or losses at the time of the retirement or death. Then we have to transfer the retiring partner share of accumulated profit or loss, general reserve, reserve fund or P&L account debtor to retiring partner capital account. Then for transferring retiring partner share of accumulated losses, retiring partner capital account debtor to P&L account. So all the profit and losses should be transferred to retiring partner's capital account. These entries we have to pass if the partnership firm decides to transfer only the share of accumulated profit or loss of a retiring partner to his capital account, and the balance of the reserves and accumulated profit should be shown in the balance sheet. Okay, it depends on the decision of the partnership firm or partners. If they want, they can transfer all the assets and profit or losses to all the partners. The previous entry is general reserve, reserve fund, P&L account to all the partners capital account. Losses all partners capital account debtor to P&L account. Okay, here they convert or distribute all profit or losses to all the partners in the old ratio. But in this case, they decide to transfer only the share of retiring partners. The other portion, that is the remaining portion of reserves and accumulated profit, should be shown in the balance sheet. Then settlement. How they are going to settle the retiring partner? On the retirement of a partner, the amount due to him will have to be paid. The amount payable to the retiring partner, being the difference between the two sides of the capital account, may be settled in one of the following methods depending upon the mode laid down in the partnership deed. He has to be settled after his retirement. He has to be settled. We have to find out the amount that is to be settled. Okay. So how they are going to settle him? There are three modes: payment in installment together with interest, lump sum payment in cash, or the amount due, perpetual annuity. So in three modes we can follow either this method or this method or this method to settle the retiring partner. Payment in installment. When the firm doesn't have sufficient amount to pay off the retiring partner, it can pay the amount in installment. For this purpose, the retiring partner loan account is opened. Interest is calculated on the basis of this account every year. Following entries are to be passed. For transfer of balance of retiring partner capital account, first we have to calculate the balance that has to be given, the amount which should be settled to the retiring partner, and then that amount should be transferred from capital to loan account. Retiring partner capital account debtor to retiring partner loan. Usually firm has to give interest to the remaining amount of the loan. Okay, so for interest on loan due, interest account debtor to retiring partner loan account. For payment of installment, retiring partner loan account, here finally they settled retiring partner loan account debtor to bank account. In this case, the loan account will be continuously shown on the liability side of the balance sheet till the outstanding amount of loan is paid to the retiring partner fully. So, it will be in the liability side of the balance sheet till it is fully settled. If the firm has a sufficient cash, it can pay the amount to be given to the retiring partner. The entry will be retiring partner capital account debtor to cash account. Okay, so they are settled spot. Okay, they give the money lump sum. Say for example, if the settling amount is 10 lakhs, if the firm has 10 lakh rupees, then immediately it settles the retiring partner. It doesn't need to give any interest to him because he is settled at spot. Spot payment is given. Okay. Then payment by annuity. If payment is made to the retiring partner by annuity, in some years an annuity suspense account is opened. Amount payable to the retiring partner is credited to this account. Interest is also credited to it every year, and at the time of payment every year annuity suspense account is debited and bank account is credited. If the partner dies before the payment of the full amount to him, the balance of this account is treated as special type of capital profit and is transferred to the remaining partner's capital account in their profit sharing ratio. If the partner remains alive and even after the payment of full amount of this account, he will be paid annuity and P&L account will be debited with the annuity. Existing partners may purchase out the retiring partner's share, for which the payment may be made by the following two ways. If payment is made privately, retiring partner's capital account debtor to existing partner's capital account. If payment is made through firm, cash or bank account debtor to existing partner capital account. Then the retiring partner capital account debtor to cash bank account. In the absence of the agreement, the retiring partner is entitled to interest at the rate of 6% per annum as long as the amount due to him is not paid.